Good afternoon, everyone, and welcome to 𝗥𝗂𝗂𝗍 third webinars in our series. I'm Chiara Caprioli from the Luxembourg Stock Exchange, and I'm here with very prominent guests today. So we have one session, the whole webinar dedicated to sustainable finance new products. This is the first of a couple of sessions, the second one taking place next week around transition finance more specifically. Before we kick things off, I would like to remind a couple of corporate housekeeping rules. So you're going to be all muted, but that doesn't mean you cannot interact via the chat box. Now, in the interest of time, we will take your questions at the end of the panel. We will have up to 10 minutes to reply to as many questions of you might have. I have the pleasure to introduce you to three prominent speakers, starting from Aila Aho. Aila has been a rapporteur for the European Green Bond standard proposed at the European Commission at the level of the European Technical Experts Group. We have Farnam Bidgoli from HSBC. Farnam is head of sustainability bonds, and she is also a member of two very active working groups within the ICMA Association. The first one that proposed a set of principles back in June to define sustainability-linked products, and the second one was working at defining what transition finance guideline might look like, and that is supposed to come to the market with a set of proposals in the next couple of months. And last but not least, we have Meuwissen. Tom is a treasury manager at 𝗏𝗏𝗯𝗶 Bank. 𝗏𝗏𝗯𝗶 Bank is a AAA rated Dutch bank of the public and for the public, with a specific focus on water and sustainability issues. As in the treasury role, Tom has advised on a number of green, social and blue bond deals, all of which are displayed on the Luxembourg Green Exchange. I would like to do some context setting for you before we go into exploring these new products out there. So what is our starting point today? Green bonds have been dominating the scene in sustainable finance, so we've seen a very linear path so far. That doesn't mean that there are new things coming up and being tested by the market. Just to remain with green bonds, to give you a dimension of how the scale is gradually getting important out there. We have reached the $1 trillion trillion mark a couple of weeks ago. That's impressive. We even have the first monthly record of $50 billion issued just in the month of September. And we have had, in terms of new issuance, for the very first time, ESG deals in the debt space that have outstripped conventional deals. So definitely too big a milestone, a turning point for the mainstreaming of sustainable finance. Now, that's not all. As I said, green bonds have been dominating the market, but the market is giving signal that is opening up to new innovations. That makes sense. Green bonds are not enough alone to fulfill the political objectives of the Paris Agreement and the European Green Deal, and they're not enough to match the investors' appetite for this kind of products neither. So what is it that we're seeing? We're seeing issuers venturing into structure like the sustainability-linked bonds, which have a broader potentially application scope than green bonds. We've seen some attempts to define what transition finance should mean for the market, giving a room for companies in not so green sector, even from high polluting sector, to decarbonize, and to do so by going into the sustainable finance toolkit. We have seen the European Green Bond Standard, of course, that is not yet completely implementable, but we think that it will give a new dynamic to the green bond products and change the fundamental of the product overall. And last but not least, we're seeing social bonds going out of their philanthropic niche to become much more mainstream from the pandemic, of course, but potentially even in what we will see in the next few months when the pandemic will be solved, hopefully. And to this extent, there is a very strong signal having been given these days by the European Commission with the announcement of a 100 billion the connections was broken for 1 second. Mark in social bonds to help member states alleviate the consequence on the pandemic, especially in relation to preserving jobs in the most affected countries. So the market is clearly moving from green to rainbow. Is much more interesting than what has been so far. And I would like to have the views of our guests in seeing how new products are reshaping the market fundamentals, starting from Aila. Aila, could you tell us what you think the green bond standard is changing from the standard labeled green bond? What is it adding up to the current practice of structuring green bonds the way they are?
Thank you, Chiara, and welcome also on my part from the little bit grey Helsinki. We set to work with the green bond standard in the tech as requested by the Commission, and I think it was very clear from the beginning that we wanted to build on the current market practice, but not leave it there. So there's no point in creating a standard which is a copycat of what is already being done. So the purpose was really to ensure that the good intentions that were included in the market practice and well documented in the Greenbone principles actually do take place, and in a credible and comparable manner, because we do need harmonization in the market so that we can scale the financing up and with actual positive impacts to the environment. So not only talk, but also the environmental actions. So the use of proceeds was the principle we chose. So that is a clear continuation of the current market practice. And linking that to the taxonomy was, of course, then taking the biggest question off the table, that what is green and what can be deemed green. In the green bond standard, it is aligned with the taxonomy, as it actually has to be, because the taxonomy regulation says that all standards created by EU or member states need to align with the taxonomy or be based on the taxonomy. Also, the green bond framework, we thought, is an important document, and that would be a mandatory one. So there are 4 mandatory parts: use of proceeds for taxonomy, 1 for the green bond framework, which the issuer needs to use to explain what is their rationale in issuing the green bonds and how does that relate to the overall strategy. So there needs to be some linkage to the overall strategy of the company. And then already familiar features like reporting of allocation and the impact reporting, they are mandatory as well. And finally, the verification, we think, is a key part of the process, and adding to the credibility and the usefulness of the verification, we thought that the verifiers should be supervised. We propose ESMA for that purpose. And the reason being that since this environmental and ESG data overall is clearly becoming so much more important in the financial decisions, it is actually quite strange that that part of the data providers and the intelligence providers are not supervised in any way, especially compared to the other parts of the market, which some people say are very heavily supervised. So there's a clear mismatch there, and we thought that it would add value to the standard itself, and thereby also ease the burden of investors, because when you know exactly what you buy and what's the value for it, it's already verified for it on your behalf. I can't hear you.
Thank you so much, Aila. So you mentioned, among others, the alignment to the taxonomy, and you mentioned the robust reporting and verification framework. Do you think that most current market participants will have the potential to adopt the standard, or do you think that it's probably something that will be addressed in the upper end of the market, so the issuers that have the scale and the capacity to promote very robust practices? Or in other words, what needs to be there for the standards to get broad traction in the market?
Well, I think that the standard itself, it will be a kind of a assurance of the best quality available. So there will be a race for the top. Everybody would who will want to use it. But due to the fact that, as in the current green bonds, the user proceeds are linked to real economy. So you can't really issue bonds unless you have the projects in the real economy. So the phase in which we get this transitioning in the real economy, that really dictates the uptake of a standard or the limit to that. I do believe there's a lot of interest, and in the initial phase, especially when the taxonomy is not fully available until end of next year, we are likely to see issuers who will be partly use it. So they align the parts where they can use the structure, do the framework and use the structure, and then gradually build up the asset base as there's more clarity on that and more availability of the actual assets. But the demand is there. The investor demand is very clear and it is there. So that's not the challenge. The challenge is the real assets in my view.
That's a good sign. You said it very nicely, the race to the top. That's what we expect the market to take up from these standards. Now, Tom, you are a treasurer. Are you already coming to grips to try to align your project to the taxonomy, although we know it's not completely implementable? It's not officially implementable yet. And what are the pain points if you're already doing so in the exercise?
Well, thank you all. Actually, well, we started issuing green bonds in 2014, and we call them water bonds. And they are basically use of proceeds is our lending to the water authorities. And the water authorities are our shareholders. And water authorities in the Netherlands are in fact the oldest form of government institution, and their main job is to keep the water from flooding the country. So the big part of the Netherlands is below sea level, so it's their job to keep the water from flooding. And actually, all the activities that the water authorities do is either climate adaptation, climate mitigation, or biodiversity. So they are really the strong focus points of the Green Bond principles. And so we set up the framework in 2014 with that user proceed formula, with the reporting, with the second party opinion by Cicero. From Cicero, we got the label dark green. So I like to say that we are very much on the safe side also when it comes to taxonomy. And so I think it will be easy for us, it is easy for us to be compliant with the taxonomy rules. And actually, what is changing in our framework or in our setup is that the base of the framework, so the formula of use of proceeds being lending to the water authorities, that remains. But every year we publish an annual newsletter with all the KPIs of the water authorities, and that is developing each year thanks to feedback from investors, and also thanks to feedback from rating agents, and also thanks to new rules concerning taxonomy, etc. So let's say the reporting, we try to align with the wishes of the market, of the rating agents, the regulators, and the investors. So there's definitely a development there. And then when it comes to the taxonomy, we very much understand the need for standardization with the investors. On the other hand, when you look at us, for instance, when you look at water authorities, I mean, which other country does have the same entities? Which other country is below sea level? So it's also a bit difficult to, well, we like to stick to the formal KPIs, but you also see the point where we differentiate ourselves from others. But all in all, we are so much on the safe side that, well, the new taxonomy will definitely impact our reporting. And so I don't see a real problem or issue there, I have to say.
Right, so you will probably be among the first adopters of the GBS to the extent you can convert some of your current green bonds into the new standard.
Yes, we definitely mean to do so, yeah. Great,
that's a good news, good to hear. I'm going back to Aila. There has been a very strong proposal from the tech group to have 100% of alignment between the project and the taxonomy. Now, there has also been a consultations out there that closed a couple of weeks ago saying that this 100% stringent criteria might be a bit too much for the market to be viable. What do you think will happen? Will the Commission propose some adaptations, and what is the risk of going below the threshold that has currently been proposed by the TAC? We do want very high level quality products, but we want them to be adopted by the market participants ultimately. So it's a bit of a trade-off, isn't it?
Well, it is indeed a trade-off between quality and volume, or the how quickly you can build up the volume. And I think that the value in the standard is the quality. We have all the other options already out there, so why expand into that direction? Anyone who doesn't want to issue according to the standard can always use the current practices. So it is a voluntary use. Personally, I don't see a lot of value in watering down the content of the criteria. However, I would like to point out that the questionnaire that you referred to was not really clear in what they meant, because in the EU Green Bond standard, we actually built in some clarifications already, which take into account the fact that the criteria are not ready, or the technical criteria are not ready yet. So it is actually written in a way that you need to fulfill the significant contribution, the do no significant harm, and the social safeguards and technical criteria where available. If they are not available, you can still issue, but you will need to get the verification of the verifier to confirm that your intentions are aligned with the principal objectives. So it is not as strict as people have perceived it to be. So there's some flexibility already built into that. Also, we specifically defined a little bit this borderline between OPEX and CAPEX, so that all kinds of OPEX that increases the lifetime or the actual value of the asset, underlying asset, can be included. Because our group was really full of practitioners, and we saw these practical challenges, and also challenges coming from the public sector. So we specifically mentioned that the subsidies, for example, from the public sector, they will be included as R&D. So we took the liberty to interpret the taxonomy in the context of a product, which was actually what we were asked to do.
I think Tom wants to say something on that.
Yeah, well, I think that it's important to stick to the 100% alignment. And of course, you can solve that in your user proceeds formula by not using 100% of your lending as user proceeds, but probably like 80% or 70%, that you create some sort of a buffer so that you're very sure that the lending that you use is really 100% aligned, so that you don't have a differentiation over there. So I think that's a good way to solve that. And actually, in our water bond, what I just mentioned, we use 90% of our lending as user proceeds, just to be on the very safe side, that you can say, okay, for instance, you do something like a climate adaptation project, but there's also a road involved, which is probably not so green. So then you say, okay, only 90% is really fully very green. So I think that's also the way to stick to that 100% alignment.
I fully agree with that, and I think that's how the current market works as well. All the, even in the green bond principles, the assets there are supposed to all of them be green. And those assets which are not green, you will not include in the bond. So going lower in this percentage is actually a violation against this user proceeds principle. And then we are starting to talk about a little bit of other products. And that to me is a different discussion.
Yeah, sure. That's a very brave and encouraging development on the tech proposal, and hopefully the European Commission will keep this idea to not to dilute the brand of the new product, and time will make things progressively viable on the practitioner side. Now we're moving to a completely new set of products, sustainability-linked bonds, Farnam. The market has been pretty much about user proceeds product so far. So green, social sustainability bonds are all products that have to say where they invest. They have to have clear transparency on the project and make sure that this project aligns to one or the other recognized taxonomy. So far, we've been seeing just a couple of examples. The first one being NL, trying to venture into new structures, but the signal from the market has been so strong that these new products are being codified in a set of principles. Sustainability-linked bonds are non-user proceeds bonds. They are general corporate purposes bonds, so the issuer doesn't have any limitation what he wants to do with the money, but they come with a promise, the promise being impact, and they come as far as promising a coupon step up in case the impact is not achieved. So they are, the issuer is committing to some sort of financial compensation to its investors base in case the impact is not there. Now, let me play a bit of devil's advocate, Farnam. These products are criticized as being the perfect products to hide greenwashing. How would you fend that off?
I mean, first of all, I think that the fears of greenwashing have haunted the sustainable finance market for since its inception, basically, and we still have this question even sometimes from with regards to use of proceeds, you know, green, social, and sustainable bonds. I think my response is that, you know, we're in the early stages of the sustainability linked bond market. As you mentioned, it's only recently been codified into the new principles. And at the core of the instrument, I would say the only thing that is really built into the instrument is that it's a mechanism for accountability. And that mechanism for accountability, I think, is something that prevents it from really being an instrument for greenwashing, particularly if an issuer does, you know, tie it to the sustainability-linked bond principles, because the risk of greenwashing is mitigated there by the fact that in the second principle around the calibration of the target, the issuer needs to demonstrate the robustness of the target by aligning to either sector pathways or providing a peer benchmarking, and also demonstrating how it is an improvement over business as usual. So we have built into the sustainability linked bond principles already, you know, a level of expected disclosure, which would prevent issuers from using it and abusing the tool to, you know, for the purposes of greenwashing. And I think that the evidence, it really is in the fact that I think when NL first introduced this structure, there was some thinking that, okay, well, now we're going to see every issuer, you know, go down this route, and it's such an easy product to structure, and it's just targets, you don't have to have projects. But actually, if you look, there's only been a handful of issuers that have come forth. We expect that that'll continue, and we have a very strong pipeline. But what we've found when working with, you know, Chanel most recently, we also are in the market today with one from 𝗟𝗃𝗃 Airways, is that actually it's a lot of work on the part of the issuer, and that the issuer has to really be able to demonstrate the credibility of the target and demonstrate the importance and the materiality of the KPI. And on the marketing side, when presenting it to investors, you know, the questioning from the investor side is just as detailed and just as diligent as it would be for a use of proceeds transaction. There's a lot of curiosity about how an issuer intends to actually meet the target. You know, what projects they have, what they see as the key levers, what they see as the key challenges. So again, I think investors are looking at this as a tool for accountability. And so just because it doesn't have the, you know, the transparency around the underlying projects built into the structure itself, doesn't mean that you're not getting a very credible proposition when it comes to the issuer's commitment towards sustainability itself.
Thank you, Farnam. You mentioned investors. I think they're not all having the same approach to sustainable finance purchase decision. Some of them might actually prefer transparency and go for user proceeds products. Some others might prefer impact because it's much more tangible into their portfolio decision and into their ESG risk management as well. Now, talking of investors, do you see any different interest from them on this product that you see from green, social, or sustainability bonds? Or how are the subscription trends, if at all, comparable between these different products?
Look, I think you make a very important point, which is that this is not the product for every investor. If an investor has built a fund around impact reporting, around being able to demonstrate that, for every dollar invested, it directly results or correlates to a real world impact in the economy, then this is not a product that provides that level of granularity. But when we look at the growth of the sustainable finance market over the past 2.5 years, particularly, the momentum in terms of investor interest has very much come from a correlating trend in an ESG integration. So this is where it's not for a specific thematic fund, it's not for a specific green bond fund, so to speak, but rather investors are buying it because they're looking more and more into the environmental and social performance of issuers. And from these investors, we very often hear, a green bond to me is a signal. It's a demonstration of transparency, and that's why I like it. But I don't actually care about the underlying projects being something that I'm directly investing in. I'm more interested in how the framework aligns to the broader issuer strategy, because what I'm interested in is the issuer level transformation. And so from those investors, this is actually a much more ideal product, because it speaks to the transformation of the business, a holistic transformation of the business, or the issuer's practices, rather than a subset of projects and expenditures. Empirically, we have a much smaller group of issuers to look at, right, compared to green, social, and sustainable bonds. So, we've always been very conservative when speaking to pricing advantages for sustainable finance transactions. I think now, with the volumes that we've seen over the past year, we are consistently seeing 5 to 10 basis points of pricing advantage, especially for corporate issuers. And in terms of oversubscription levels, usually a 20% increase in subscription at the point of pricing. Now, I think so far we've seen similar trends for sustainability-linked bonds. We just executed for an Aila a sterling transaction last week. That was about 7.5 times oversubscribed, and certainly the issuer did see a pricing advantage compared to their conventional curve. But I think it's too early to say that these instruments will definitively provide a pricing advantage in the same way that we do now see on the use of proceeds side.
Thanks, Farnam. I think it's clearly too early. We don't have critical mass to come to conclusions, but what you say seems to be showing that there is a progress compared to the very first sustainability-linked bonds 1 year ago with NL. There's clearly interest from investors, whether or not it translates into strong oversubscription trends like for the green bonds. Tom, would you like to add something on your experience? Is there a greenium on your product? Is there any different premium from green, social, water, blue bonds? How would you put that into the real life of a treasurer?
Well, first, probably something on the sustainability linked issue we just heard. Actually, what we try to set up is make our loans to our clients sustainability linked. So, of course, as an on-lender, as most big issuers are in this market, it's very difficult to link your sustainability to specific targets. It's always a bit debatable, but when you pass it on to your clients, the end users, then you can really also add value. So we are trying to set up a thing like that. On our own bonds, there's definitely a premium, of course, for green and social and sustainable bonds. Well, it's just a matter of supply and demand. And of course, there are plenty more investors interested in, well, ESG bonds than there are in normal bonds. And we found it out when we started, and it's sort of established in the market that also when you negotiate with a bank about a new issue, and then it's a green, for instance, then well, it's a bit debatable, but you can say 1, 2, 3 basis points difference is definitely on the table. What I have to say is that also in the after performance, they do perform better and they are more stable. So it's not that as an investor that you really lose those basis points. You can also say, well, it's just a better bond anyway. So in that sense, we have definitely experienced that. And of course, the order books, they are normally way oversubscribed. So really like 3 or 4 times. I think also these bonds are normally so oversubscribed because you are a bit limited in your use of proceeds formula. So normally when we have a benchmark issue and it's 1 billion and we have a book of 3.5 billion, then we can say, okay, we make it 2 or 3 billion, the end book. However, in your use of proceeds, you are normally limited, and therefore you also see more tightening and, well, a smaller new issue premium, if any at all, for these kinds of bonds. So that's definitely one added value. However, what we experience as the most pleasant about this whole thing is more your dialogue with the investors. So they prefer the transparency. They like to see what's being done with the bond, so they see that the user proceeds. But we also experienced the last few years reverse roadshows from investors. So we have now an annual event where like 20, 30 investors from abroad, they visit the Netherlands. We visit sites from the water authorities. We visit sites from social housing. They really like to see what's being done with their money. So it really leads to another dialogue with your investors. So not only about spreads and liquidity, but also really about what are you doing with our money. On the other hand, it also is a close cooperation with your clients, because you set up the framework with your clients. They take care of the reporting. And so it's all in all very positive indeed. And last but not least, it also has an impact on the employees of the bank. So it's more in the awareness. And actually, we as a bank, we now also agreed with the carbon reporting. So in fact, we report now the carbon of our balance sheet for 93% already. And that's all started with these kinds of bonds. So I would say that all in all, it's a very positive development.
Interesting. Thanks so much. Farnam, there's another aspect I would like your expertise on, and it's a controversial aspect of this product. We know they're new, so things are getting fine-tuned for sure in the next few months. But isn't there a perverse mechanism around the fact that the issuer promises a financial compensation if the non-financial impact is not there? Meaning, are investors not at risk of speculating that the issuer doesn't reach the target to have some sort of financial compensation? So is this kind of core element of the whole product here to stay, or shouldn't alternatives be explored going forward that are less perverse in their mechanisms?
So I think, 2 points on this really. The first is I don't see the coupon step up as a core element of a sustainability linked bond. I think the sustainability linked bond principles were drafted in a way that was quite broad in order to allow for the market to continue innovating in this realm. It speaks of a financial or structural characteristic. Certainly we've already seen some innovation. So on the Chanel transaction that we worked on, there was a premium payment that was paid at maturity if the issuer fails to meet its sustainability performance target. And on the 𝗙𝗂𝗅𝗏𝗔's transition sukuk that we're marketing at the moment, the mechanism is built around an investment in a nature-based solution. So essentially a compensation paid towards offsetting the potential negative sustainability impact if the issuer fails to meet their target. So there is scope for innovation, and I don't think that we need to consider the coupon step up to be necessarily the only realm in which you can execute a sustainability linked bond. But I will say, and we've heard this perspective from some investors. You use the word non-financial impact. So from the perspective of a lot of investors, especially as we look towards the integration of environmental and social factors into the real credit analysis, the coupon step up is a material compensation for the deterioration in credit quality if an issuer fails to meet a sustainability target. And so we've heard from some investors that this is a way in which they can divest from the issuer without necessarily causing financial penalty to their end clients by benefiting from the coupon step up. And we've heard from others that, again, as they're buying into these bonds for ESG integration purposes, if an issuer does fail to align to its targets, particularly I think on emission reductions, this becomes very clearly a potential material point. That widening of the coupon is a way in which they're being compensated for that deterioration in credit quality.
Thank you. So there is room for more innovation, and probably it's already there. It's not being communicated as strong as around the step-up mechanism. Now, we have some 5 deals, I think, in the market, many of which, I think 4 of them, have CO2 reduction targets. So in principle, an issuer can choose any sort of sustainability target and indicators, but in practice, most of these products are around CO2 reductions. Now, this brings us to a very hot topic, which is transition finance. There is crossover between this product and what might be the transition bond format, which doesn't exist yet. So there isn't a transition bond standard yet, but there is some talk in the market around defining some rules for companies that want to decarbonize independently of which sector they come from. Now, can you tell us a bit where the market consensus is in relation to this set of principles and rules that are developing? Farnam. You're muted still.
Have to happen at least once in a webinar. As you're absolutely correct, we as part of a working group at the ICMA have been leading the market's work on developing some guidance for transition finance. And I think actually we're nearing the end of our work. We're hoping that it will be released next month. And one of the primary I think conclusions of the work has been that adding a separate instrument outside of, let's say, use of proceeds instruments or sustainability linked instruments could create unnecessary market fragmentation and further confusion. What a transition bond is, compared to a green bond or a sustainability linked bond. And so we actually will be providing a sort of handbook for issuers, but that handbook will very much define a transition bond as one that can be issued either in alignment with the green bond principles, the sustainability bond guidelines. So that would mean basically it could be issued as a use of proceeds instrument, which is financing transition projects, or it could be issued as a sustainability linked instrument, which again has a financial or structural characteristic tied to the achievement of certain sustainability performance targets. What we did also conclude after a pretty expansive market consultation on this point has been that I think there's a widespread view that, first of all, transition needs to be defined as transition towards the goals of the Paris Agreement. That it cannot just be that we think about transition as a slight improvement over business as usual, that it needs to have a clear endpoint in the medium and long term. And also that transition is very much achieved at the issuer level. And so the instrument, again, is a way of evidencing and developing a transparency and accountability towards that transition. But for an issuer to be credible in issuing a transition instrument, it needs to have a corporate level or issuer level strategy when it comes to climate transition. And there are 4 key kind of elements that we have been hearing about as the key disclosures that investors and other market stakeholders would expect to see. And these are around the governance of transition, so demonstrating clear oversight and accountability, demonstrating the clear materiality of the transition strategy towards the business model, alignment again to science-based pathways and targets, and finally transparency when it comes to the implementation of the transition strategy. So whether this is towards disclosing actual expenditures, but also what are the processes, what are the behaviors, what are the system level changes that need to happen in order for an issuer to be able to achieve its targets. So these are the kind of corporate level disclosures that we would expect to see accompanying any sustainable finance instrument which was meant to finance climate transition. Now, this doesn't mean that we won't see transition bonds. I think that the market will continue to use different names for profiling and marketing reasons, and certainly I think that there are a lot of issuers that are much more comfortable using the transition label rather than a green label. But what it means is underlying that issuance will be either a bond that is issued in alignment with the green bond principles, the sustainability bond guidelines, or in alignment with the sustainability linked bond principles.
So there a lot of crossover between transition kind of products and potentially green bond or sustainability linked bonds.
Exactly.
You mentioned the strength of the Paris alignment, the strategy in the corporate at the corporate level. Do we also need a brown taxonomy for user proceeds products that will go to invest into products that needs to be predefined and specific? And if so, do we have one already? What can that look like going forward? And this question is addressed to Farnam, but also to Aila, because I think that some of this brownish kind of nuance are already embedded in the new taxonomy, but maybe there will be more to be developed in the next iteration of the taxonomy.
Yeah, I'm keen to hear Aila's view on you know, how the technical expert group and now the platform on sustainable finance views this. But I think from my perspective, all I would say is in the same way that the development of the taxonomy has been so critical because of the need for kind of a standard language when we talk about, you know, what can be classified as a sustainable activity, I do think the market would benefit from similar guidance when it comes to, you know, what is considered to be every shade in between, basically. So, you know, what can we define? And I think there's been some inclusion of it already within the existing taxonomy of some activities being defined as transition, but certainly I think more clarity on this would be useful for the market.
Yes, thank you. Happy to continue. Yes, indeed, as you mentioned, the taxonomy already includes the transition activities, which de facto, that if which are typically very carbon intensive activities, which have a potential to transition towards the net zero carbon, but are currently very far from where they need to be in 2050. So it's transportation, it's a lot of manufacturing and real estate, all that. So for these transitioning bonds or transition bonds, actually, if all the investments that will take the company over the threshold of becoming green, they actually can be included as taxonomy aligned. For that part, we don't need a special kind of bonds because they can be called taxonomy aligned or green already. But of course, this captures only the activities which are in the taxonomy currently, and hopefully some more will be added by the platform and commission going forward. There are clearly some high emitting sectors missing currently. The brown taxonomy, in a way you could say that they do no significant harm, which is an essential part of the taxonomy concept, kind of establishes the brown floor below which you shouldn't really go.
Mm-hmm.
And so there's some guidance embedded in the taxonomy on this brown side already. And we will get more of that once we get the other categories identified more clearly by diversity and all those others. So we get the threshold for which you have to go over to be significantly contributing, but also the level below which you should not be going, i.e. the significant harm. And I believe it's important that we get that to look beyond carbon and beyond climate, because the other environmental aspects are also very important in terms, even though it's called brown, it actually could be called harmful. I also, as Farnam said, I also would see merits in creating a brown taxonomy. So this is a personal view, partly because that currently there is a sector in between, in between the clearly green and clearly brown, and that is neutral in the between, because there's always going to be some activities which are neither especially positive, but not specifically harmful either. And currently they, maybe rightly so, are saying that they don't like to be mixed up with the brown sectors. They want to be clearly defined as the neutral ones, and currently they are suffering a little bit on how to explain that to the investors. So that would, I think, would clarify that we would have at least these three camps that would clarify the situation. Besides the do no significant harm, I believe that the risk matrix that EBA and the bank supervisors have already been asked to create, and us banks will have to report at some point on how we integrate ESG risks. I don't know how that can be done without a brown taxonomy being established. Otherwise, there's very little harmonization and too much subjective interpretation. So I see it coming, and a lot of it is, many of us can see it quite clearly. In some sectors it's pretty clear, but in some others there's more work to be done, clearly in biodiversity, water, things like that.
Thanks, Aila. That was very insightful. Now I'm looking at the watch here because we are getting to the final part of the webinar. I don't see any questions proposed by the public. Please do take your chance to interact with our panelists. Meanwhile, we might have a few coming up in the next few minutes, but meanwhile, I would like to close on social bonds. We didn't speak too much about these products yet. It's true there have been products pretty much in a niche until the pandemics. There have been a kind of stigma that they are just reserved to the public sector, if we're talking of issuers. There's also a stigma on the investor side that they might not carry enough financial performance if you compare it to other instruments. And last but not least, if we're talking about impact, the metrics are somehow not as scientifically developed as some of the green environmental metrics. All of this is true, but I think the pandemic is bringing a lot of issuance on the market, and when issuance, the progress around best practice. I'm asking a question to the three of you. I don't know who wants to pick it up. Do you think that there will be a much more interesting role, more legitimation for these products in a post-COVID, post-pandemic phase? Or how do you think this market evolve, in other words?
Can I start?
Sure.
So, well, I think in general, the social bond market is lagging the green bond market by 5, 6, 7 years. So I think, well, we issued our first social bond in 2017. And in that year, we were the biggest social bond issuer worldwide because the market is still rather small. However, I do think that there's huge potential in it. The difference that you mentioned is, of course, that on green bonds, it's easier to provide quantitative reporting, and investors like quantitative reporting, like CO2 reduction, energy renewal, all those things. And in social, it's more difficult to quantify the KPIs. So there's more qualitative KPIs. However, I do think that there is indeed huge potential in this market. Well, you see that now with COVID, but I think that definitely also other areas are there to be expanded. One thing on green is that what we've experienced anyway is that the interest with investors is more universal. So you can imagine that an investor can also have a feeling like, what's in it for me? So for an investor in the US, it can also be attractive to buy a bond with CO2 reduction in Europe. When you look at the social bond, and then you can say, for instance, we issue social bonds on our lending to social housing. For a US investor to improve the social situation in the Netherlands, where he might think, well, that's quite a prosperous country anyway, why should I care about that? Probably there's more social things to be solved more near to my own environment. So therefore, what you see in the investor base, at the moment anyway, is that in social bonds, well, we have only issued them in euros so far. And the green bonds is more universal. So that, but I think that the situation will develop. So as I said, it's 5 years lagging, and probably social has even more potential than green, especially also when all the governments are starting to issue these kind of bonds. And you see it also now with the EU. So I'm very positive on that. Well, actually, what we have done ourselves, just to finish, is that we had a social bond based on the lending to social housing in the Netherlands. However, social housing is also doing things for the environment, like making the new homes more energy friendly and stuff like that. So we've changed the format from social bond to sustainable bond just by adding 2 SDGs based on the environment, but also to make it more attractive for the investors worldwide. And that definitely pays off. So for now, I would say investors are still in general more interested in green, but there is huge potential for social.
Do you share Tom's views, Aila and Farnam?
Yeah, I do believe there's demand, and of course this pandemic came as a surprise to everybody, but demand has clearly been there. And perhaps this is an opportunity to also, or personally I would think that any brand that increases transparency, whether it's social bond or green bond or anything, it adds value to the investor and to the overall market, simply just through this transparency. So that in itself is a positive thing. But the social, of course, as a concept, it's more difficult. It's more loaded with personal aspects and even political choices. So it is potentially more challenging to find a consensus for the matrix on that. And as Tom said, it will probably take some time. At the same time, I think we are already seeing that the bar is rising for all kinds of bonds and debt and equity as well in terms of human rights, labor rights. So the level of decency, of level of acceptable behavior is raising all the time for all issues, labeled or not. So kind of a bar is rising already. So that's also positive.
Yeah, I would absolutely agree with that, and I think, you know, in the same way that Tom mentioned, you know, incorporating green criteria into into the social bond framework. We've seen that also from, you know, a lot of the green issuers that we've worked with over the past year in particular. Now that social has kind of come to the forefront of investor thinking, there's a lot more focus on, you know, how the social aspects of a project are managed and how they're also potentially, if there are risks, mitigated. I think we have seen a huge maturity of the social bond concept this year. And I think whilst the immediate catalyst was COVID-19, I do actually think that it's sort of long-term growth is all but guaranteed. COVID-19 kind of made it more tangible for a lot of investors, and also, to be frank, the volumes now are big enough that it's no longer seen as a niche market. And that was even before this week's, you know, 17 billion issued by the EU. We were already seeing, you know, upwards of 100 billion issued so far this year. We've seen two French agencies, CADES and UNIDEC, you know, transform their debt issuance programs to be entirely social. So now financing the entitlement and social security programs in France. And I think that has also meant that investors can look at it as a, you know, as a more advanced instrument, rather than before, where it was kind of seen as this very niche instrument, and green was where most of the growth in the issuance was. You know, the holy grail here is very much corporate issuance, and we've seen some issuance from corporates over the past couple of years. We worked with Pearson earlier this year, so obviously they're financing access to education. Danone was a pioneer in this field with their issuance a couple of years ago of a social bond, which tackled some of the real social issues in their supply chain. So I think there are some social corporate social issuances that have started this market, but that's where we really see the next big surge of growth to come, is to see more issuance from the private sector as well.